In 2008, while millions of Americans were losing their homes, retirement accounts were collapsing, and Wall Street was in full panic, a small group of investors made billions of dollars. They didn't buy stocks, they didn't invest in growth. Instead, they bet against the entire market, and they were right. This strategy is called shorting, and in this video, we're going to break down exactly how it works, why investors use it, and how some people make money when stocks fall instead of rise. Most people understand traditional investing. You buy a stock, you wait, the price goes up, and you sell for a profit. If you buy a stock at $100 and it rises to $150, you make $50. This is called going long, and it's how most Americans invest through retirement accounts, brokerage apps, and long-term portfolios. But what if you believe a stock is overpriced? What if you think the market is heading for a crash? Do you just sit and watch your investments fall? Not necessarily, because there's another way to invest, and it works in the opposite direction. Shorting flips the entire idea of investing upside down. Instead of buying low and selling high, you sell high first and buy low later. It sounds backward, but the concept is actually straightforward. You borrow shares from a broker, immediately sell those shares at the current market price, then wait for the price to drop. When the price falls, you buy the shares back at a lower price, return them to the broker, and keep the difference as profit. In simple terms, you make money when the price goes down, not up. That's short selling. But this is where things get risky. When you buy a stock, the worst possible outcome is the price goes to zero. Your losses are limited to what you invested. However, when you short a stock, there's technically no limit to how high the price can rise. If you short at $100 and the stock climbs to $200, you lose $100. If it climbs to $500, your loss becomes $400. This is why short selling is considered dangerous. Losses can grow quickly, and in extreme cases, they can be massive. A real-world example of this happened in 2021 with GameStop. Many hedge funds believed the company was failing, so they heavily shorted the stock. But retail investors began buying shares aggressively. The price started rising, $20, $50, $100, then several $100s. Short sellers were forced to buy back shares to limit their losses, which pushed the price even higher. This created what's known as a short squeeze, and billions of dollars were lost. It showed how risky betting against a stock can be. There are several ways investors short the market. The first method is direct short selling, which is the traditional approach. You borrow shares, sell them, then buy them back later at a lower price. This method is the most straightforward, but also carries the most risk, and it's typically used by experienced traders. The second method is using put options. A put option gives you the right to sell a stock at a fixed price before a certain date. If the stock price falls, the value of the put option increases. Many investors prefer this strategy because the maximum loss is limited to the cost of the option, making it less risky than traditional short selling. The third method is using inverse ETFs. These funds are designed to rise when the overall market falls. For example, if the S&P 500 declines, an inverse ETF tracking the index would move higher. This is one of the easiest ways for investors to bet against the market without borrowing shares or using complex strategies. However, even inverse ETFs carry risk, especially when held long-term. Investors don't only short to profit from crashes. Many use shorting as a hedge. Hedging is a way to reduce risk in a portfolio. For example, if an investor owns a large number of tech stocks, they might short a tech ETF. If the tech sector falls, losses in the portfolio may be partially offset by gains in the short position. This creates balance and helps manage volatility. Despite these uses, many long-term investors avoid shorting altogether. Historically, the U.S. stock market trends upward over time. Betting against that long-term trend can be difficult. Timing has to be precise, and even if an investor is ultimately correct, they may still lose money before the market turns. Because of this, many investors prefer to stay long, diversify their portfolios, and hold investments through market cycles. Still, there are times when shorting makes sense. During bubbles, extreme overvaluation, economic instability, or when weak companies begin to collapse, some investors choose to bet against the market. However, timing is everything. Being too early can lead to large losses. Markets can remain irrational longer than expected, and short sellers often face pressure before their thesis plays out. Shorting is one of the most powerful tools in finance. It allows investors to profit in falling markets, hedge risk, and take advantage of overvalued assets. But it also carries significant danger. When you buy stocks, your downside is limited. When you short stocks, your risk can be unlimited. That's why understanding the mechanics, the risks, and the timing is critical before using this strategy, because while shorting can create huge profits, it can also lead to massive losses just as quickly.